Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Dan Wantrobski. He's the Associate Director of Research at Janney, Montgomery, Scott, to discuss why valuations are attractive and liquidity will remain ample even with QT programs ahead. Dan, it's great to have you with us. Welcome to Trade Talks.
Hey, Jill, thanks. Glad to be here.
You got it. And let's start with some backdrop here. In June, the markets hit deep oversold conditions on extreme bearish sentiment. Since then, the markets have begun to stabilize in base, and you believe that they should continue to do so for the remainder of the year. But for some historical reference, how does this compare to other market cycles?
Yeah, so we think one of the biggest culprits to all the volatility we have seen throughout much of this year has to do with the U.S. and its transition from a disinflationary macro environment towards a reflationary or inflationary sort of macro backdrop. And what's confusing investors is really, how do you model for growth and multiple expansion in a rising interest rate world? And to get a sense of what can happen here, we use history as a guide. The last major cycle that we had in this country that was similar to where we find ourselves today actually occurred after the Great Depression and just after World War II in the mid-1940s period. At that time, the US in the mid-1940s really came across rapid explosion in inflation. In fact, the CPI index at one point in 1947 registered a high of nearly 19 or 20% year-over-year growth. And that really triggered the Fed into a major reversal in its policy stance. Prior to that, it was working to be very stimulative coming out of the depression and the contractionary cycle that we saw in the 30s and early 40s. So the Fed reverses course to start fighting all this inflation, and the knee-jerk reaction from the markets was an immediate upwards of 25-26% correction in stocks that lasted for a few months. Once the stocks found a bottom around 1946, ongoing uncertainty and confusion about central bank policy going forward and how it would target and fight inflation in the years ahead in the mid-1940s, that created a lot of uncertainty and confusion in investors, which led to more of like sort of a range-bound trading path for stocks. See, we think there's a similar transition taking place today. Investors have gotten used to a declining interest rate environment for the past 40 years. I mean, think about it. Interest rates in this country peaked in 1982 when the 10-year was trading closer to 14-15%. Since that time, for the last 40 years, every time the economy stumbled or the markets became destabilized, the Fed's reaction was to lower interest rates, inject liquidity to stimulate stability and growth, right? So you get this V bottom when the Fed comes in to lower interest rates, add liquidity to the system. What happens after 40 years of being conditioned, right, to that type of response from the Fed? Do you get when the central bank can no longer have that policy at its back to either create stability or promote growth? Right, so investors have sort of lost this backstop from the Fed. The Fed can no longer lower interest rates, right, and inject liquidity. In fact, it's doing the opposite.
Right.
So again, there's a lot of confusion in terms of how do you account for growth and multiple expansion with this new regime from the Fed. So it's that 1940s period that gives us this great analog to test against. And what we think is happening here is there's other tailwinds underneath the surface that are allowing for economic expansion to eventually resume. And they are valuations, as you said up front. You know, number one, with the correction this year, stocks have not become dirt cheap, right? They're not as cheap as they were, say, at the 0809 bottom. But relative to where we've been in the past, we have contracted the multiple significantly in over the past few months. The S&P back in June, right? I mean, we've been sort of rallying since June, but back in June, the S&P multiple got into the mid-teens. On a historical basis, that's relatively attractive. So you have valuation at one point. The second thing is demographics. The demographic profile in this country, in my opinion, based on our work, very, very healthy. Yes, you have retiring baby boomers at around 82 million that will confront the system in the years ahead. But listen, behind them, there is a massive engine of growth. And that is Gen Xers at about 50 million, millennials at about 93 million, and then watch coming up through the ranks, Gen Z, which is roughly 82 to 83 million in scope. they have not even entered the economy, the workforce yet. They're still, for the large part, in school. So a solid demographic profile is also needed to promote economic growth in times of, policy uncertainty. The third, as you mentioned, is financial conditions. Even though the Fed has talked about and communicated quantitative tightening, in other words, pulling some liquidity out of the system in order to slow down the pace of inflation, be very careful what they're saying versus what they're doing. Number one, the Fed has injected the most amount of new liquidity ever seen in history as a result of the COVID lockdown back in 2020. In fact, it nearly doubled M2 money supply in a matter of months. The US remains awash in massive amounts of excess cash. The Fed's attempts at pulling that away is minimal in scope relative to the size of how it's expanded its balance sheet. So we think that even though the Fed is going to pull back and tighten some conditions through rate hikes and quantitative tightening, liquidity and financial conditions here are actually going to remain very accommodative and conducive to growth. So you have a couple of things here. You got
right. So Dan, because it feels like now, excuse me for interrupting, but it almost feels as if the market is trading as if the Fed is going to dial back a bit. It doesn't feel as if we're trying to slow growth, trying to get the employment situation under control. It's still very, very tight. It feels as if the market's trading on a more accommodative Fed.
Yeah, and that could be the case. Remember, coming off of the June low, so we've seen a massive rally over the last several weeks, right? So in June, the S&P hit around 3,600. Since then, we've tacked on tremendous gains, and they've been broad-based. Part of this is a shift to that, okay, the Fed's efforts to slow inflation through aggressive rate hikes and quantitative tightening has in fact cooled some of that inflation, right? So there'll be a less aggressive going forward. But the other component of that rally was really deep oversold conditions and extreme washout. We didn't see the type of capitulation in June that, say, we saw at the 2020 bottom or even the 2008 bottom, but it was very close. There was a washout. There was extreme bearish sentiment. So it's two things working today, to your point. First is, yes, people are now rethinking, will the Fed be as aggressive going forward as it has previously communicated? But the other part of this is a washout, very low valuation creates that sort of vacuum. So a lot of this is an oversold bounce. We're not necessarily saying the market sort of stages this explosive V recovery and it's off to the races in a new bull market again. We think there's going to be a little bit more back and forth as macro uncertainty. So inflation uncertainty, policy uncertainty, as well as what's happening in China, what's happening between Russia and Ukraine. All those factors weigh on investor sentiment. So we actually don't think there'll necessarily be sort of a V-type recovery here, maybe more of a sideways trading range. But the punchline and the bottom line is that we still feel like demographics, valuation, overall financial accommodation is going to remain conducive to economic growth in the years ahead. So that even though the markets will see some more volatility in the back half of this year, we think they are basing, we think they are bottoming, and as such, we think this secular expansion cycle is going to resume in the years ahead. Our target is still for the S&P 500 to track towards 5,000, 6,000, and I do believe that can occur in the next 3 to 4 years, possibly sooner.
But Dan, don't you think it's almost healthier for the market to kind of see these ebbs and flows and not go straight up or straight down? Because both of those movements are only sustainable for so long. I mean, if you think about the averages over a number of decades, to your point at the top, these ebbs and flows are a little bit easier for investors to digest versus, markets doing 2, 3, 4, 5% round trips on each trading session.
Yeah, you're 100% right. I mean, slow and steady wins the race over the long run. And what we're seeing now is an absence of retail investors really involved in this market. This backwash and this rally that we've seen since June, a lot of it is short covering. A lot of it is excess money flow from institutional investors, shorter term quant traders, day traders that are really pushing a lot of this volatility. Retail investors, for the most part, are still kind of on the sidelines because, again, they're very worried about all those different concerns we talked about. until they come back in and sort of stabilize some of this volatility, like I said, we don't especially see this type of V bottom kind of materializing. And so to your point, we can chop around here with some of this volatility for a while longer. The key for a longer term investor to ask is, has the bottom been put in place, or are we close to the lows? And do we believe that the US is transitioning from a structural bull market and expansion cycle towards a structural bear market and contraction cycle? Based on our work, we see this as an ongoing expansion cycle. We do not see transition into a massive bear market cycle here. So that means for our longer term investors, even though we have to withstand all that short-term volatility and that chop back and forth, longer term people want to kind of stay the course and in fact even use it opportunistically. If you have sideline cash, you can kind of slowly here and there choose your spots in those sectors that you want to add exposure to, or those places where there's good value. And so that's how we're kind of trading this glide path for now.
All right, Dan, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.